Ladies and gentlemen, welcome to the Midday Market Madness. In today's video, which I almost didn't even go live, I'm not feeling great, to be honest. But we're here. It's a very important day. I only have to do it a couple times a year, so thought I'd tough it out for Jerome Powell and hopefully a 25 basis point cut. That's the expectation. That's my hope. The chance of a Fed rate cut, I actually haven't checked this. Let's see. Is it still at 87? 89.6, roughly 90% right now on the chance of a rate cut. If we go ahead and check the market's reaction going into today, the triple Qs are down 1.5%, while the SPY is up 0.1%. Quite interesting. Let's see the big names moving midday. Firefly Aerospace, Rocket Labs, Lightspeed is up 5.7%. That's interesting, eh? Novo Nordisk, Chime up another 4.4%. This name is not being stopped. We're up almost, nearly $10 since our original purchase. That's insane. 25.37 on Chime. The interesting part, I wanted to talk about SoFi Smart Card because this is such an interesting new product that's being rolled out. And it almost goes directly against Chime, in my opinion. Like if you were to put Chime Card, which is their brand new sort of secured card that's supposed to be a main card, high benefits, 1.5% cash back on a rolling basis. So the categories change over time. SoFi says, you know what? That's all confusing. We're not going to roll your categories, but we will give you 5%. The difference of 1.5 and 5%, huge difference. We'll give you 5% on groceries. There's an additional 5% cash back for dining, but it's with a specific app. But still, so food is 5% cash back. Boy, oh boy, that's quite exciting. Also, no rate cut for the month. I mean, I wouldn't like to see that, but it there still is a possibility that that's not the case. We can't forget that there has been a couple of Fed governors that have come out and said they are not in favor of a rate cut. So we'll have to see. Adding up the numbers, it does look like we do get a rate cut here, but we will see. Trash, give me 3% on everything. I think once you add on the APY, the secured card benefits, which is another main thing, it's not directly competing with the Robinhood Gold Card. This is a secured credit card. Okay, so SoFi does offer a 3.3% cashback sort of like starting thing. I think it goes down to 2.2%, but 3.3% for the first year. But this is a secured card. The interesting part about this is that you will just inherently be accepted into this card. There's a lot of people who want SoFi products that do not have access to them because they might not have the FICO score, the cash flow, or the job status for SoFi to accept them onto their credit card program. Okay, so that has been sort of a running concern on the company the entire time. Whereas this secured card, I think, will be given out to anyone that possibly wants it, including people that are, do not use credit, do not have good credit scores, like 500 credit scores. It's a credit building product as well. The only difference is to get this product, it does look like you will need to pay $10 a month after so right now it'll be direct deposit. The direct deposit part to get high APYs and everything will still be the case. You could still get your 3.6% with direct deposit, but there'll be almost tiered levels of SoFi Plus is what it looks like. One, which is the smart card all-in-one account, which is the card, the high APY and boosted APY as well, the credit building services. They said they're going to do other lending services with it as well. We'll have to see. We will have to see. $120 a year fee. Yes, except you're getting all these additional services. So it's not just a card fee, it's almost an entire banking service fee, which, like, put that up against Wells Fargo or one of these ones where you're paying that regardless. It's like, okay, you're getting 5% cash back, you're getting 4.3% APY. If you have enough money in that account, can you make more having your money in savings make you more than that $120? Doesn't take a ton. The $16 chime was really the bottom, huh? I think so, personally. It was way too cheap, and it didn't flag that for me at 16 alone. It really started to flag for me once it went under 20, like 19. I was like, okay, what's going on? And I was like really looking for bad news, and I couldn't find any. And then like 17 happened, and I was like, okay, I'm gonna start a position here. And then 16 happened, and I was like, I have to believe, I've got to trust myself. So then I bought a decent chunk, but it's not like I poured, my portfolio into it. It still remains one of the smaller positions in my portfolio. But I didn't get time to. Tom Lee's on CNBC. We can check. I have it open on my other monitor here. Oh yeah, he is. Wow. Okay, one sec. You're so right.
Terry, and he's only got a few meetings left, so maybe he's, of
course, job market.
Soon for the big decision for you, other than you're expecting a more hawkish Fed, and Barry, you're expecting one that's a little bit more dovish. So Tom, you're more in line with consensus right now. What would that look like, and why are you still bullish on stock prices?
Well, I think precisely because our clients are expecting a hawkish cut. So exactly as Steve laid out, Fed does a cut, but future cuts are uncertain, not even maybe until June. Now, because that's the base case, then
unfortunately, I cannot change the audio.
Markets have already been bracing for that, and they've been bracing for it since October. And of course, there's a chance that it's a dovish cut, which would be bullish as well. And then I think
what to you would be a dovish cut? So, are there projections? Are there dots?
Yes,
there is.
right. And it could also be interpreted dovishly if they start acknowledging the balance of risks are shifting, so that then markets can realize the Fed is now acknowledging there's some underlying fragility of the economy. And of course, now QE is because QT is ending, it's essentially not QT, which is QE. And there's, of course, the chance that there's something positive the Fed has to say. So I think it is a hawkish cut, but actually I think market reaction's positive.
And there's so much more you're queuing up here we're going to get into, but on a top level, why isn't it a bigger roadblock for markets, Tom? You could look at this and just say, well, we're already basically at all-time highs. Look at the Russells and so forth. And Powell's been known to not have a very favorable reaction to his commentary, and he's only got a few meetings left, so maybe he's even more hawkish than usual. I don't know. Why don't you think that's a bigger risk? And whether it's, I'm not just myopically even talking about this afternoon, but kind of setting the tone into year end and then into next year.
Yeah. I mean, I think part of it is just the market's now adjusted to the idea that the Fed is institutionally slightly hawkish. Now, part of it may be because that there could be undue pressure coming from outside the Fed, and the institution wants to protect its integrity, and that comes across as hawkish. But that dynamic is something the markets have been bracing for, and they've reacted negatively to it, like in October they did. And so I think because of that, that's what people are building into this December meeting, which is why it could be a surprise.
It's like when Apple always gives cautious guidance. The stock always sells off after earnings, and then it does fine again. And they also, of course, have the post-COVID period to react to, where you know that someone like Powell, who's about to leave, is going to want to say, I didn't reopen the door to inflation, right?
Yeah, that's right.
For that
Protect his
institutional
legacy.
Exactly. So Barry, all of that said and done, there are still lots of people starting to talk about this quantitative easing issue. So it's a little bit confusing when you have, are we to view that even as economic policy making, or is that something completely different that just has to do with the plumbing of the financial system?
So for 3 years, you and I have been talking about the Fed eased primarily using their balance sheet, but tightened using only one of three channels that they have, which is they've just been draining reserves from the system. And so that's the plumbing issue, which is getting tight. But the much more important and impactful part of QE is when they're buying treasury notes and mortgage-backed securities. That lowers long-term rates, which is what really influences equity prices and other risky assets. And they suppress volatility by buying mortgage-backed securities because of prepayment.
When do you expect them to come back into the market, the treasury market?
Well, it is not lost on me, it shouldn't be lost on any investor, that the 10-year treasury yield has moved from 3.99 on December 1st to 4.20 since the Fed began what I'm calling DT, duration tightening.
Oh, and no, now I'm confused.
Right,
Keep going.
now they're reinvesting their mortgage-backed securities pay downs into treasury bills, not into treasury notes.
Right.
So that means they're buying 17 fewer billion per month of we'll call them 5-year treasuries for simplicity's sake, and they're buying bills instead. And so that's putting upward pressure on longer term rates. This is when Kevin Warsh talks about shrinking the Fed's balance sheet to encourage private sector lending, he's skipped a step in there. The step is deregulating the banking sector, lowering the GSIB surcharge, widening the supplementary leverage ratio, doing all these things that could potentially expand bank balance sheets as much as $6 trillion from the 22 or 3 or so billion that they currently are.
That they should be the buyers.
They own the debt. This is crucial in the long run, that a price-sensitive buyer owns the government debt, not a price-insensitive buyer. So when the government starts spending like drunken sailors, as they did in 2020 and 21, and drive spending to 30% of GDP, they're not able to just
keep going,
finance it, and keep going. And so this is a crucial transition that needs to happen this year.
But the reason,
so yes, I'm a dovish on the Fed cutting the policy rate to try and steepen the yield curve so small banks can participate in this process.
That's what Paul McCulley talked about. A lot of people are saying they should cut because they want to renormalize the yield curve.
That's right. So their policy rate has been overly restrictive for floating rate borrowers, small businesses, Russell 2000 companies. You know, Tom and I have tried to get bullish on the Russell 2000 for the last couple of years. This is part of the reason why it hasn't worked. But policy's been accommodative for long-term fixed rate borrowers, investment grade companies, relative to high yield companies, for example. So for me, it's crucial that they allow that duration to return to the wild, go back into the market, reinvest in bills, but lower that short-term rate. And
just to put a point on that, so I can follow you when you say, look, the rate is too high, it can come down a little bit, fine. But then they also need to restart QE. Okay, I guess they do.
They're not going to restart QE. If I'm right about deregulating the banking sector,
they're going to restart
QE. It'll be totally unnecessary.
They're going to restart QE. They're already basically admitting to that.
Well, Powell's not going to be chairman anymore. And integral into what Bessent is asking the next Fed chair to do is deregulate the banking sector. If the banking sector doesn't need to hold $3 trillion of reserves because the requirements don't force them to,
about the balance
then
sheet.
We're not going to have tight repo rates.
Yeah.
So that's how we avoid the Fed expanding their balance sheet and interfering with the price of the most important security in global markets, the 10-year treasury.
Absolutely. But Tom, the reason why we fixate on this, which sounds wonky, but it's not, especially if you're in the crypto world, for instance, where you hear people saying QE is coming, the liquidity is coming, buy Bitcoin or buy whatever crypto asset or buy stocks because this is coming. So it's important to know whether it's coming or not.
Comes from the banks, though.
Yeah, but yeah, in the crypto world, QT was draining liquidity. So the ending of QT is essentially QE, because if they're just holding the balance sheet flat, they are still going to be essentially adding liquidity to the system.
Just to maintain the size.
Yes. And so that is why I think crypto prices have risen in anticipation of this meeting.
So do crypto prices keep going? Do you have a bullish view still on small caps if we're finally going to get that rate coming down a little bit? Where should people look for alpha or outperformance?
Yeah, I mean, like 2026 is a year like there's a new Fed, right? But a dovish tilt. And at a time when the ISM's been below 50 for a record more than 3 years. So that's really good for small caps. And as Barry says, if they deregulate banking, and we were talking about this offline, that's really good for small caps. But that's also really good for the business cycle. And we've talked about this in some of our past research. Crypto prices are really sensitive to the ISM. So the ISM moving back above 50 has historically been associated with actually super cycle moves in Bitcoin and Ethereum.
Wait, ISM going into expansion territory is positive for Bitcoin and
Correct.
for all, oh, interesting.
Yeah, and so if you look at ISM and Bitcoin, and you detrend Bitcoin, essentially look at its distance from the 200-day, it's almost perfectly correlated to the ISM.
Surprising.
And
but
same thing with copper to gold prices. So copper's an industrial metal versus gold is a
right, but all of that tells you that it's basically just risk on, that they're all behaving like an economy. And is that, am I overcharacterizing
Yeah, I think
it?
I think that's right. I think Bitcoin's a bit of a chameleon because there'll probably be a time when it acts like gold, but right now it acts a lot more like it's sensitive to monetary policy and the business cycle, and both are about to turn up. So that would mean anybody who thinks the Bitcoin 4-year cycle means crypto prices are down next year, we're betting against that, thinking that new highs come early.
That's
like in
fascinating.
January.
As a final word, we're about to talk to Jason Furman, Barry, who says the Fed should not be cutting because of inflation. And I'm just curious what your response would be to that.
That the rate did not trigger the 2021-22 inflation. The Fed cut the policy rate from 1.5 to 0, but then they bought in 21. They bought $1.5 trillion of securities, which injected that amount of reserves into the system. At the same time that Janet Yellen drew down the Treasury General account, didn't issue, and injected another 1.6 trillion in reserves. That government spending and Fed purchases of assets, which facilitated the government spending, is what drove house prices up 46% in 18 months and drove goods prices from -1 to 12.5. So I would much prefer the Fed controlling inflation by expanding the term premium for longer term debt, trying to cool off this excessive speculation that people like Beth Hammack are worried about, steepening
In the AI
yield curve,
space?
right? And steepening the yield curve so that small banks can start lending to small real estate developers and small businesses, and we can stabilize the part of the economy that's really weak.
So again, you think they can lower rates and still lean against the AI bubble?
For sure, because the thing that determines stock prices over time, we create an equity risk premium. We use the 10-year TIPS yield, the real yield from the 10-year part of the curve, not the policy rate, right? So this liquidity versus longer term rates is a crucial distinction. And I would argue to Jason, if they really want to control inflation, the thing is making this process, privatizing the Fed's balance sheet so that price-sensitive buyers own the debt, and the government can't go wild.
Barry wants long-term rates to go higher. You're never going to get a.
They're not going. I want to be clear. They're not going far higher because Bessent does have some tools underway. The deregulation of the banking sector. He could eliminate the 20-year. There's other things he's going to do.
Yeah.
But I do think a 440 to 450 move or so in 10s early in the year and a much steeper yield curve is probable.
And that would be the right formula. There'll be a quiz after the break if everyone's been following on. But I like the nuance here because there's much more to it than simply what they do is short and long.
The balance sheet is just so crucial, and it was so crucial to what happened in 21.
Yeah.
And it's so crucial to the outlook going forward. The Fed owns $6.25 trillion of securities. The committee at the last meeting in the minutes said they think that portfolio should have roughly the same duration as Treasuries outstanding.
Yeah.
That would imply they should own $2 trillion of bills, not $200 billion.
We don't even need stable coins. We're solving all these problems at once. Gentlemen, thanks. Really appreciate it. And of course, we'll find out in 45 minutes what they decide. Barry Knapp and Tom Lee, thanks for coming on set today.
Okay, I'm fully aware that it was very quiet, so I'm going to come back quiet and allow people to adjust their audio as we start to talk up a little bit. Okay. Anyway. I don't know how or why the CNBC live stream is so unbelievably quiet, but it is. And I hear it too. I agree with some people. Like, stop listening to things on full blast and you can adjust your audio a little bit whenever things are quiet. But yeah, CNBC videos are fine. It's the CNBC live stream on their website that is so quiet. It's unbelievably quiet. So I would like YouTube TV or something. Somebody in Canada needs to let me know what's the best provider for me to get all of these channels. Like, Don't care the cost. I just want all the channels. But yeah, for CNBC, I'm just paying for them directly on their website, but it's quiet on the live stream. My speakers just blew out when you came back. I tried to come back low. I did. Okay. I listen to CNBC at work, then I get a call from a client. My eardrums are gone. Okay. Yes, I mean, I hear it low too. Like, it's very low, but I also have, it's sort of mid-range in my audio, so I just turned it up a lot whenever they come on. But then if something happens and you have to switch over to something else, that gets loud. David Velez was on CNBC not long ago. I'd love to listen to this. It's a little off topic for what we want to get through today. However, if you guys know, Nubank is one of my top holdings. So this is a little bit of just for me, but obviously Nubank's still an incredible investment. In case people are looking to diversify or get into some Latin American businesses, they are, the fastest and largest Latin American fintech, one of the biggest neobanks in the entire world, aside from some Asian neobanks. But let's have a listen. This audio should be a little bit better.
Joining us right now is Nubank's CEO, David Velez. Good morning to you. This really is a big move for you guys, and I wonder what it portends in a larger way for where you're trying to go here.
Thank you, Andrew. Well, this is really the continuation of the thesis that we've been executing for 12 years since the beginning of the company in Brazil in 2013. Our view is that financial services will go through the same transformation that all industries across the world have gone through digitalization. And we've been able to prove this model in Brazil, Mexico, Colombia, getting to 127 million customers, becoming the largest bank in Latin America in terms of number of customers, at the same time showing one of the highest profitability, consumer satisfaction. And the US is the biggest market in the world. It's half of the world's market cap. While in some areas, US seems very mature. In some areas, actually, there is a lot that US can learn from countries like Brazil, where Brazil has gone through significant digitalization in payments, access to financial services, and we see this thesis continuing in the US and beyond. So it's part of a continuation of taking this digital banking model global over the next 5 to 10 years for us.
When you think, though, about getting into this market, what does that ultimately look like? Who do you see as your competitors? And by the way, it just seems to me that increasingly the financial services industry is actually getting more fragmented in certain ways rather than less. I mean, I think there's been a sense, at least in the United States, there's been all this consolidation, but we now have all of these new entrants.
There are more entrants, but at the same time, if you look at the banking concentration in the US, ultimately you have something like 6-7 banks owning 60-70% of the entire market cap. So it hasn't really changed that much in decades. And that's actually true globally. Today, something like 95% of the $8 trillion market cap industry is still dominated by big incumbent banks that are still banking in banking branches. It's amazing to see that while in a lot of the areas, you look at China, for example, the entire banking market has digitalized. You don't really see banking branches anymore. People are doing digitally. Even in the US, banks are still opening banking branches, and people are paying the cost of that physical infrastructure. It's almost like you still had to go to Blockbuster to get a video, a VHS. You're still paying very high fees to go to the Blockbuster to get a video. And that's the opportunity that digital banks bring in the US and globally. The moment that we are able to launch a market where our cost structure is 100x more efficient than traditional banks, we're able to pass that efficiency to the end customer via way lower fees, right, way lower interest rates, and a much better consumer experience. And that's the thesis that more or less will be playing.
David, do you think it's a mistake? Here in New York City, you could go on, not every corner, but a lot of corners. You could walk into a Bank of America branch, a Chase branch, a Wells Fargo branch. I mean, there's a lot. Do you think that they are making a terrible error? Do you think that 5 years from now, 10 years from now, the big banks are going to say, we should have never been doing it this way? This is the Blockbuster model. Or do you think, as they say today, that they actually get more business as a function of having these branches?
I think it depends a lot on the segmentation. I think New York specifically is one case where you have a very high income population that have very sophisticated financial services needs. And so if you're investing millions of dollars, if you need a very big loan, yes, you likely need to still go to the banking branch and sit in front of a human. But even New York, Manhattan reminds me a lot of Sao Paulo in 2013, 2014. You would walk around Faria Lima, which is the equivalent of Fifth Avenue, and you would see the same bank having banking branches in the same corner. That's just a symptom of lack of competition. In an environment where you have significant competition, nobody can afford having some of these big buildings, paying some of the highest real estate costs in the world to serve customers with very simple products. So what you'll see is that for a lot of very simple product, savings accounts, credit cards, lending, in very basic investment, the majority of the mass market, you can do that fully digitally without the need of all of those banking branches in every corner, and consumers will be able to save a ton of money on fees on that infrastructure.
I imagine you're going to plan to spend a lot of money here in the U.S. in terms of marketing, because you're going to have to market this brand. How are you going to do that?
Yeah, I mean, I think we have a plan about appealing to specific niches initially. Obviously, yes, it's a very large market, it's a very competitive market, but when you go deep down one level, you go beyond New York or California or the big metropolitan areas, you actually find very significant percentages of the U.S. population that is very underserved, where historically there's been a lot of community banks that are not serving very well a lot of these customers. You see a lot of very big, large niches that don't have great access to credit, that are paying very high fees, that could be using better consumer experience. So we'll have a very focused strategy. We won't necessarily come in investing a ton of money on marketing. We'll be very specific on the areas and niches that we see, that we think that there is a path to go. And we'll be very thoughtful and build from there. But there is a lot of technology and infrastructure that we built over 12 years, serving 127 million customers, that we think is going to help us provide a very good product in the U.S.
Capitol Hill.
Some people asked if Nubank is looking to take on SoFi. It's not that they're actually looking to take on SoFi. Like you said, the high majority of people are still stuck in incumbent banks. And honestly, I think they're more leaning towards helping the customers that are on Chime's side. You know, that's sort of the problem with being Chime in this area. It's very easy for companies that are in the higher demographic to work their way down. It's hard to start serving low-end customers and work your way up. That's a much harder solution. Okay. So I don't think that Nubank, remember how many fintechs and banks there actually is. Once you see a single company enter into an extremely large market, this does not mean that SoFi is doomed or anything along those lines. Anything. Okay. What's happening to Meta? I don't know. Let's have a look. Yeah, Meta's having a little bit of a selling pressure. Nothing crazy here, but down 1.8%. Let's go have a look. I was just recently reading comments from Hassett that were coming in, though. We'll look at Meta here in a second, but Hassett said that 25 basis point cut would be a very small step in the right direction, and that if they had stronger data, that could support a 50 basis point cut. You could definitely get to 50 basis points or even more. These are some recent quotes from Hassett today. Pretty incredible. Okay, let's take a look at also 2 new cryptocurrencies had just got entered on Robinhood. Let's take a look at Meta and see what the heck is going on in the metaverse. And I don't mean, you know what I mean. Meta owned 3 out of the top 6 most downloaded apps in the Apple App Store in 2025. That's just incredible. By the way, ChatGPT came out at the very, very top of the Apple App Store rankings for full year 2025. Meta reinforced new AI model using Alibaba's Quinn model. Alibaba jumped up 4% on that news. I don't know if that's probably not taking down Meta, however. Yeah, I'm not really seeing anything on Meta right now. Could just be jitters. Maybe some algos. Who does know these days? I just bought more Uber. Yeah, this has been an incredible name too. People have just like sort of expected the worst from Uber. This is year to date after putting up, some pretty extreme numbers almost every single quarter. But we've had some of these just insane candles selling off this company from fears of Waymo not using them as much, Tesla coming out of the woodwork, killing their business. I mean, so far, none of it is actually showing up in the financials, right? And I think if you could compare it to anything that we've seen in recent history, this could be almost like the Google search moment. No one I know uses this. The second that AI is developed, Google search is dead, yada, yada, yada. And then really what you end up finding out is that Uber will actually partner with a lot of these fully autonomous businesses. They will monetize it at potentially even higher margins than what they're doing currently with drivers. I'm not saying that that's going to be the case, but like I would legitimately put that at like a 50-50 chance of they actually get a lot stronger and build a much bigger business on top of fully autonomous vehicles, not the other way around. Just absolutely insane how cheap this company is becoming. Similar to Duolingo, I mean, it definitely could be. I find it a little bit different, but yes. Uber purchased an AI company that deals in self-driving cars. Yeah, they've been all over the self-driving thing for sure. Dara's like, that's the only thing that he's been talking about. By the way, I visited the Uber headquarters in San Francisco. I didn't know that you tech engineers, the people in chat that work for these extremely large tech companies, have it like that. I didn't know. They treat you guys well there. It's quite incredible. No, I joined the stream late. You're just on time, my friend. We've got about 27 minutes left until we hear about the actual rate cut decision, in which point there will be another 30 minutes to break down that information. It won't take us nearly that long, but to go through the FOMC statement to then end up seeing Jerome Powell's thoughts in the actual conference at 2:30, which hopefully is on time. Ethereum's popping. I feel like people say this and then I look and then it's up like, I mean, little popping. 33.83 on Ethereum. BMR has had quite the comeback. And in fact, if you guys saw my video from yesterday, the change in BMR's multiple has just been insane. So essentially, it was maybe 3 weeks ago or so where I highlighted that BMR's MNAV, or market net asset value, fell below 1 times whenever you included their cash. Okay, scary place to buy. If they're under 1 times, you might be able to get a premium, like purchase that amount of Ethereum or purchase that amount of cash, then cheaper than you would with the amount of cash that you have. But that also could mean that they can't dilute to go buy Ethereum because they're under a 1 times MNAV, and that would sort of, not be so good for the business. You can only dilute to buy more of what you already have if that MNAV is sharply above 1 times. Well, now we're back to 1.3 times, which is 1 times meaning like, if you were to add up all of the Ethereum and their cash, okay, like what's the book value? Like if you were to sell this company for parts, okay, what's the quality of the business worth? What's what's the book value? You would look at the Ethereum, you'd look at the cash, you'd look at their Bitcoin. You know, they don't have hard assets like massive buildings and stuff like this or machinery. So it's just the Ethereum and the cash. Whenever you add all that up, and that all of their hard assets is worth more than the market cap of the business, then people have very, very negative expectations of where that company is going. Okay. But whenever you're back to a 1.3 times, meaning the market cap is about 30% higher than their book value, people get very excited about the future of BMNR, right? And now that's where we are again. We're sort of back to that level. Now, we're not back to the $60 BMNR prices because the Ethereum that we're holding is not, you know, 4,700 a coin. So you can have an even higher multiple, but not a higher stock price than we were before. Plus, you know, all the dilution and everything in the lower Ethereum can affect the price of the, you know, tokens. But as we break above 40 here, cleanly, congratulations, everyone. It's been a long time coming. As we break above 40 again, the fact that they have such a high multiple means that people have a very big belief for the future of this company, and that they can go ahead and sell more shares to buy more Ethereum, and that can go a long way. A long way. So now we just need Ethereum to continue to pump higher. Yeah, do your little happy dance. You know, $40.10. It happens quickly. This name that everyone wrote off, Scam Lee, everything like this. You look back at the last month, we've gone from $40 down to $24.33, back up to $40. But for a treasury name, this is actually a superpower. Okay, every single week that this went on, and it wasn't even that long, but the time that we had made this dip, Tom Lee was buying the whole time. That's a strength, right? Because if you were to look at their average cost of Ethereum, it would never be as low as where it is if we didn't have this dip. And not just the strength of BMNR, but how much, you know, how much were you able to accumulate while this was down? I think my lowest buy was 26. 26, and I didn't lower my average as much as I probably should have, but you know, I didn't want to like full port into BMNR. But I know some of you guys have been, and if you guys have been full porting into BMNR at $40.40, we're like Can you explain? Wait, where did that go? Can you explain why a company buying Ethereum is worth more than Ethereum plus cash? Well, no, it's a company that's Ethereum plus cash is worth more than Ethereum itself. But yeah, anyway, essentially, it's their velocity, it's their ability to, whenever they stake, they will be able to stake at a much better rate than us. They will be able to buy Ethereum at a much better rate than us. You know, there's certain funds that can purchase BMNR that are not allowed to buy Ethereum. So they can go out and essentially use BMNR as a trading tool. You know, you can write very easy options on BMNR. You can buy leveraged ETFs on BMNR. There's and it's such a clean name as well. Like whenever you buy BMNR, I find whenever you buy strategy, there's things that you need to, you know about all their different and unique raising strategies. For BMNR, it's like, okay, well, they ended up selling more shares to institutions, raised money, and bought more Ethereum. That's that. You know, it's just a very easy name to understand. Okay. let's see. BMR can withhold Ethereum from the market to raise demand. That, I think, is why they had sort of waited a little bit to stake. That's my understanding, is that they, whenever you essentially go to stake all that Ethereum, then that's no longer supply that's being passed around. But yeah, if a bunch of treasuries and everything are buying and holding and they're not selling, that does artificially bring up the price of Ethereum because you have more buyers and there's a lack of sellers. Look at us come all the way back down. We're below 40 again. By the way, we need to talk about SoFi again. I was right. Okay. They did pick Solana for their stable coins and SoFi USD and all of those products. That was oh wait, let's check Ethereum's price right now. Are they back above 3,400? No, see, that's why BMR is falling fast, is Ethereum's falling fast. Yeah, Jay Powell is speaking at 2:30. We're going to get the rate cut decision at 2 o'clock. Okay? At 2 o'clock. But SoFi is using Solana for their stablecoin, which is fine. Some companies are doing that. You look to Fiserv, for example, a part of PayPal USD, they're sort of multi-chain, and maybe SoFi USD will also be multi-chain, where they will collect essentially money from both Ethereum or Solana, depending on what their customers want, which is most likely what's going to happen if they want to get to any real size, which is where like PayPal USD is getting one of the largest stable coins. Okay. Let's see what else is going on. 2026 US GDP growth. Yeah, let's hear from MasterCard to hear what they're expecting in 2026. I can't believe this. We're going into 2026, guys. TGL is starting in 18 days. Life is just flying right past me.
With us now at Post 9, first on CNBC, Chief Economist of the MasterCard Economic Institute, Michelle Meyer. Great to have you back at Post 9. So the outlook for the U.S. is even better than this year.
That's what our expectation is, yeah. Because when you think about this year, it was a story of uncertainty. It was a story of headlines. It was a story of change. And I think in 2026, it's going to be a story of an economy that's adapting, an economy that's proven to be much more dynamic. So we're looking for U.S. GDP growth in 2026 of 2.2%, with continued expansion in some of the tailwinds that we've already seen, AI being a big part of that, but also the settling following a lot of the trade realignment.
What does it say about the consumer? Because investment in AI has become such a big part of the economy and the growth right now.
Yes, but remember, the consumer is as well. The consumer is actively engaged, and we're seeing that right now in this moment with the holiday shopping season. We had Black Friday spending at 4.1% on a year-over-year basis. For the overall holiday season, we're looking for mid 3% pace for holiday spend. We feel really good about that number coming through with what we're seeing with the recent data flow. So I do think the consumer is engaged. And I think that AI is just an important story in terms of keeping that economy flexible, keeping that economy moving forward and helping it navigate what has been a lot of other changes out there.
Like trade or
like
what
trade.
else?
Yeah. I mean, and one of the stats that we saw, which we showcase in the report, is if you look at the trade realignment between China and the U.S., it's been tangible. And we can actually see it with our aggregated spending data. We looked at U.S. spending on e-commerce in Chinese mainland. And the beginning of the year, from January to April, spending was growing at about 20% on a year-over-year basis. From May to September, it was contracting -6% on a year-over-year basis. The offset was Europe, where you saw an increase in cross-border spending of Europeans on Chinese mainland e-commerce. So it's showing up in the data. And a lot of what has happened is also a consumer that has, I think, pretty amazingly navigated all of these shifts.
What happens to inflation in the U.S. next year?
So we do expect to see, moderate inflation, but a very split story. So when you consider where the inflation has already started to show up, the good side of the economy, there's likely to be more of that. I don't think we're past the hump yet because it's a slower transition in terms of the cost pressures showing up for the consumer. But on the services side, there's a lot of disinflation that has come through, and I think that continues. So overall inflation should remain fairly contained. I don't expect to see major shifts in terms of the headline number from where we are now, but continued adjustments in terms of the sectors.
Besant said that if SCOTUS rules against them on IEPA, that they could recreate that structure using other forms. Would that create lingering uncertainty, weigh on jobs, weigh on investment, et cetera?
Yeah, I think clearly any policy changes from here, we've seen it throughout 2025, is that it does create a degree of uncertainty. And when you're faced with uncertainty, businesses will pause, they'll wait and try to understand what's going to come next. But one of the things that showed up in 25 is even though there was some pausing in terms of certain job creation, right? A little bit of this slowdown, the churn in the workforce or slowdown in hiring rate that was apparent in the spring and early summer, there was still an active investment in the digital economy. There was still an active investment in AI, and that didn't change. So it's a reallocation of capital as well.
So it seems like the underpinning of your pretty bullish view on the U.S. economy is about the consumer and the resilience. How much of it, though, is high income versus low income, which we've heard anecdotally and also started to see in the data, are going in different directions?
Yeah, so it's never even. That is a reality of our economy, and I think it's a story that's worth exploring more as we enter into 2026. And a lot of that will rest on two factors: the health of the labor market across different types of jobs. And you do see, if you look at the Atlanta Fed data, for example, the lower income tier is seeing a more of a slowdown in wage growth than the higher income population. So keeping a very close eye on that. That's an important cohort. And then the balance sheet as well. The household balance sheet has been very supportive. It's a very positive wealth effect that has continued, but that's not driving consumer spending evenly across the income level, right? It's just those that have access to that wealth.
So what's the forecast for next year?
2.2% for U.S. global GDP of 3.1%.
2.2, better than this year.
Yes.
Not as good as the administration is hoping for, though, on the 4% level. But
well, I think that would require a very large productivity gain and probably a much bigger engagement in the workforce. So nothing is impossible.
No,
I would say.
AI is here. Michelle, thank you very much. Good to see you. Thank you for breaking.
Okay, just to clarify, everyone, before we get into the rate decision, which will be in 12 minutes. Okay, so we're nearing that time. I want to hear from a couple different economists to hear their thoughts on the Fed before we get into it, and then we'll actually hear at J Powell at 2:30 if he's on time. Which will be another 30 minutes, sorry, for Eastern Standard Time. After the bell today, we also have Oracle, Adobe, and Synopsys. Oracle is going to be a huge name, especially for the data center trades. They have been selling off quite largely from their initial RPOs from ChatGPT. Let's have a look here. Where is it? Here we go. If we go back, we don't even have to go back that far. Their last quarter earnings, which you can see the earnings results here, saw a massive bump up. Massive bump. $345.72. Now seeing a big sink lower. They are expecting, Wall Street's expecting the highest amount of revenue that they've ever seen at $16.17 billion, and then an additional $1.50 in EPS, which was higher than last quarter as well. But it's going to be a lot about, how are those deals with OpenAI? Do you have the cash to get those deals? Who is a part of those deals financing those future data centers? Are you tapping debt markets? A lot of this, the market feels like they already, believe. A lot of it is going to have to come from debt, but a little bit of extra insight into that might clear some things up. Remember, if you guys are new to the channel, if you're just popping in for the first time, I am an extreme bull on the AI trade on NVIDIA. Who knows which companies are going to win the actual LLMs? I'm not sure if it's going to be ChatGPT or Gemini or Meta or whomever. But all of it leads to more chip purchases and, NVIDIA does look to continue to cement their lead here. Okay. I'm not necessarily confident in Oracle either, but it depends. Buy a bell, no more water bottle. Well, I won't be able to have a bell for 2 o'clock. I will definitely be celebrating if we get a 25 basis point cut. Okay. Tesla's the one. What, in terms of winning the AI trade? I mean, that definitely could be true as well. Okay, let's have a look at this video as well, and get ready for the next piece at 2 o'clock.
Joining us here at Post 9 this morning is PNC Asset Management Chief Investment Strategist Youngyu Ma. Welcome back. It's good to see you.
Thanks, Carl. Great to be here.
We've been talking about how built in the consensus view is about this afternoon. Any reason to think there might be surprises?
Well, the consensus view on a hawkish cut is pretty well established, but it's interesting sometimes when you get actually the result of the consensus, so if the Fed delivers that hawkish cut, sometimes there's actually some pent-up energy in the market that could move it in one direction. So even though we're probably going to get what's expected, that doesn't necessarily mean it's a non-event today.
Right. Actually, that's a fairly common view today, that the FOMC and maybe Oracle tonight are clearing events for a market that's kind of been rudderless last few days, right?
Well, searching for direction, and the CapEx story is one that's in question right now, whether or not that's sustainable and whether or not that's going to lead to the actual benefits relative to the costs that are being sunk in. So there are multiple stories going on right now, and I do think that it's important for the Fed to kind of clarify the narrative that it sees and really emphasize what it is focusing on going forward.
Right. What do you think the chances are that that narrative involves a reacceleration of growth going into 26?
I don't think the Fed is, I do think there's that possibility. I don't think the Fed is going to really put the flag on that. I think the Fed's really going to talk about the labor market, mostly inflation a little bit. There are a lot of cross currents in the labor market today, mixed signals out of the data we're getting. And what the Fed is focusing on and what it's emphasizing, I think, is what the market's going to be keying off of in the messaging that comes out.
Are stocks ignoring the bond market right now in this backup in yields we've seen to 4.2 on the 10-year?
Well, it's important. I don't know if stocks are ignoring it, but they're eyeing it. And I think if we get a larger move, then stocks are going to respond more cautiously if we get a larger move in the 10-year yield. So I'd say there's a bit too much complacency right now, but it's not completely ignored.
Capitol Hill.
Okay, really quick, I also just saw this come across. I don't know if you guys agree with this or not. 20-year-old lottery winner rejects $1 million in favor of $1,000 weekly payment for life. Boy, oh boy. I can't express how much I disagree with that. I mean, the math just doesn't check out. If you're planning on spending the money and you think about it in terms of spending, then you say, okay, would I rather blow $1 million today or would I rather blow $1,000 each week? $1,000 probably makes some sense. But whenever you think about investing that money and, taking $1 million today, you're going to make a lot more than $1,000 a week for life would be, or would be over time. And then you also need to consider how long are you going to live anyway? And plus inflation, like someone said, 52,000 over 60 years. What the heck is $1,000 a week going to be in 60 years from now? Nothing? Like, not nothing, but, inflation is, that's a big key. You got to own assets. And it's better to own assets today than it is to own assets tomorrow. But whatever. Whatever, to each his own. It's definitely not a bad decision. Like, either way, I mean, you're getting $1,000 a week for free. Not a bad strategy, I guess. Win the lottery, guys. That's my financial advice. But do you guys know I've never actually played the lottery? Well, that's not true. I played the lottery one time whenever, and by the way, rate cut decision is in 5 minutes. So let me pull all this information up, make sure that we have it available. I'll also throw up the cues. Make sure we see the reaction of the markets in live time. Do you guys want to see the cues or the SPY? I feel like the SPY is a little bit more reactionary to the Fed rate decision, especially because they have financials. The NASDAQ doesn't have financials. Maybe I'll look at the SPY. Okay. I prefer the Qs as an investment, but you know what? The SPY might be a little bit better here. Okay. The people have spoken. I know the SPY was like 95%. I don't even remember what I was saying though. I just never had played the lottery. That's it. Someone bought me a couple tickets for my birthday whenever I turned 18. I was able to play it the first time. And I remember thinking, like, I hope I don't win because I do not want to be addicted to this. And I didn't. And yeah, best decision of my life. Instead, I'm getting into 0 DTE options. No, I'm kidding. We're getting into nice, fun, long-term investing with a splash of staring at the markets on minute-to-minute candles. That's all. 4 minutes. As of today, Uber has started to deteriorate, and I don't get why. I think that's a crazy reaction to what's actually going on. They make a crap ton of money, and until that changes, I don't think the sell-off is actually worth that right now. Brand new Tom Lee interview. This could be very exciting. Released this morning. Okay, I got to watch that as well. Let me make sure that I pin that. Okay. 2 minutes and 15 seconds until the decision. I've got the calendars up, the statements ready, the press conference here. We go. What are we hoping for? I think Polymarket, someone said there was like a 97% chance of a 25 basis point cut. Mirren said that he was going to only do 25 basis points to not jeopardize that going through. He's not just going to put 50 basis points in as sort of like a statement piece because he knows obviously that's not going to go through. So we'll see. What's also nice, the SPY almost perfectly flat today. Okay. JP Morgan to give $1,000 to staff who earn under $80,000. Okay, what? You chose the salaries, bro. Just you don't have to give them one-time benefits. Just increase their salary. To give $1,000 to staff, people are going to celebrate that. Wow, so brave. Okay, here we go. There's a 97% chance on Robinhood of 25 basis point cut. Okay. 45 seconds. What do you think is going to be faster? Like, do you think me getting it right off the website is going to be faster or me on X? Somebody with a Bloomberg terminal. I think it's going to be on the website. Okay. 20 seconds. We need a little countdown. Watching the market. Yeah, that's true too. The market will tell us, but we don't never know. Like some of it might come through the statement as well. The chance of a rate cut is already so high that I don't think that that's going to change whenever we get the reaction now. Look at all the volume. Oh, issues FOMC meeting. Job gains have slowed this year, and unemployment rate has rate of 2% over the long term. Where is it? In support of the goals, the committee decided to lower its target range for the federal funds rate by 0.25 percentage point to 3.5 to 3/4 percentages. That is bullish. We got a rate cut. That's a 25 basis point cut, ladies and gentlemen. The evolving outlook and balance of risks. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. Who would have thought? Okay. Let's see what else. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the... Okay, let's see here. Reading of labor market conditions, inflation expectations, and financial and internal developments. I got a cough. Voting against this action was Stephen Mirren, who preferred to lower the rate target by a 0.5 percentage point at the meeting. Goolsbee and Schmidt also preferred no change to the target. There were 3 dissenters here. 2 people said no change. One governor said 50 basis points. Everyone else said 25 basis point cuts, including Jerome Powell. Williams, which is hilarious, because that's what actually kicked off a lot of the, sort of fears of no basis point cut, was Fed Williams, and he voted for 25 basis points. Okay. Do we have projections here as well? Summary of economic projections. We have SEP. Okay. The projection in September was 1.8% in real GDP. Is now 2.3% for 2026. Unemployment rate stayed flat at 4.4%. PCE inflation went down to 2.4%, and core PCE inflation also went down to 2.5%. Here, let me switch this out really quickly. Obviously, the market's going to digest this a little bit. But as you can see here, change in real GDP expectations for 2026, now 2.3%, and a slight increase to 2027 and 2028. Okay. Lowered the rate for 2027 as well. All right. All right. Let's see what the market also has to say about this. We'll go to, and I apologize for the audio whenever we check on CNBC here. Sometimes it can be quiet on the live streams, but I'll stay quiet so you can turn up the volume.
And the balance sheet. Mr. Sullivan, quickly
Explain all of this to us, and how are they going to up?
So if the labor data can
Reserve reducing interest rates by an expected quarter point to a new range of 3.5 to 3.75. There were 3 dissents. The first time that's happened since September 2019. 2 were against the cut, including Chicago Fed President Austin Goolsbee, along with Kansas City Fed President Jeff Smith, his second dissent in a row. Also, another dissent for a 50 basis point cut from new Fed governor on loan from the administration, Stephen Mirren. To recap, the vote was 9 for cutting a quarter, 2 against cutting, 1 for cutting 50 basis points. The Fed signaled a higher bar for the next cut, using language that it's used in the past to do so, saying that it will assess incoming data to determine the extent and timing of future rate moves. That language it used it last December to signal a pause. The rate outlook suggests consensus for just 1 more cut next year and 1 more in 2027. But as I'll get to when I talk about the dot plot, a lot of disagreement. Before the dot plot, though, I want to talk about some pretty big news when it comes to the balance sheet. The committee making a determination, it is now at what it calls an ample level of reserves. So it plans to initiate purchases of shorter-term treasuries on an ongoing basis. And then a separate document was specific, saying the Fed will begin buying $40 billion in bills starting December 12th. That's just a couple days from now, And I believe that's sooner than the market expected. And those purchases will go on for a little while at an elevated level because of seasonal demands for reserves that are out there before coming down again in April. That's what the document says. Outlook on the economy in the statement. GDP outlook was stronger next year in the Fed's own forecast, up 0.5 point to 2.4%. So pretty big move there in the outlook for GDP next year. The inflation outlook lower for next year by just a tick, down to 2.5%, just about hitting the target of 2.1 in 2027. The statement says the economy is expanding at a moderate pace. Job gains have slowed and unemployment has edged up. Just a note, the statement no longer says that the unemployment rate is low at the current rate. Inflation is seen as somewhat elevated. Economic uncertainty also elevated. Back to the Fed outlook and the dot plot real quickly here. Only 2 dissents, but 6 officials in total wanted no change in the funds rate according to the dot plot. So kind of a soft dissent in that regard, you can call it. 7 want no change at all for next year. 11 only want 1 cut next year. One person, and we can imagine who that is, Stephen Myron, just guessing here, wants rates down to 2.12% next year, or 150 basis points lower. And that is the statement and the outlook for rate cuts and the balance sheet. Mr. Sullivan.
Quickly, sir, you said buying bills maybe sooner than the market expected. This is not QE. I do not dare call it that. But is this like the son of QE, quantitative easing light?
You know, Brian, people are going to take off on this, and I don't want to stop the craziness that'll happen in social media and on the interweb. The Fed will say this is maintenance of its balance sheet at a level of GDP of where it was. Some people, however, will call it QE light. Some people will call it son of QE. I believe the Fed will say this is neither, that this is simply maintaining the balance sheet at what they call the ample level of reserves, and that will cause them or prompt them to begin buying $40 billion of bills. It looks like 3 years. They also may go out a little bit into the bond market as well, but they want to stick to the short end of $40 billion a month until about April, when they say there'll be a sharp decline in there. And Brian, call it what you will.
Let's see what Rick Santelli calls it. Steve, stay right there as you continue to dig through this. The market reaction initially showed a very dovish tilt. We have stocks moving to session highs. We have bond yields falling. Rick, your interpretation?
Well, my interpretation, Steve nailed it. I don't disagree with social media going hog wild. They could put any spin on it they want. Ample reserves to deal with the reverse repo market issues, but it is QE, call it QE light. And once again, I have an issue with this, and my issue is simple. Every crisis, they expand the balance sheet by buying securities to manage rates or manipulate rates. Pick any M word you want. But in the end, this is something to really pay attention to. And finally, the markets themselves, we saw a couple of basis point drop pretty much across the whole curve. 358 down to 356 in a 2-year. 10s were hovering right around that 416 level. They dropped about 2 basis points to 13 and change. They're right back to 415. What's notable is where we were this morning, as Brian pointed out, the fact that we're toying with 420. Remember, we closed at 457 last year. We're getting ever close to unchanged on a year that many analysts and experts thought we'd be spending a boatload of time under 4%. We've had a total of 8 sessions close under 4% so far in 2025. The dollar index, no surprise there. It's down about 1/3 of a cent. It was down about 1/4 of a cent before the statement was read. It's definitely toying with this 98 3/4 to 99 level. It seems to have lost its hunt for 100 recently, but that makes sense considering the Fed's easing. And finally, the next meeting, January. Many are talking about the January 28th meeting. For a while today, we had about a 30% probability of a 1/4 point ease. That's now moved to around 24%. It's been bouncing around a bit. If you look at the March 18th meeting, that's also hovering around a 25% probability of a 1/4 point cut. But basically, the real issue for 2026 is how much the market's going to pull out on the easing mentality as we continue to get data that certainly doesn't look like the labor market is dying a quick death. And in terms of inflation, not a lot's changed in the last 16 months. It's sticky, and it doesn't seem to be coming down closer to the Fed's target.
Rick, appreciate it. And we'll circle back in a moment. But let's get more from Mike Santoli. Mike, on what jumps out to you about the market's reaction here and what.
Before we hear from Mike Santoli, whoever was the person in chat that told me to do the volume booster, okay? I didn't know that there was a volume booster extension. Someone just put that in the comments. That's why you heard that ridiculous pop in volume. I apologize. I didn't know how it was going to work. It just shot up. I thought that maybe there was going to be a bar or something that I could have adjusted. There's a bunch of different people that are saying it was them. But yeah, that was awesome. That was awesome. We are now fixed. I feel great. And going forward on this channel, we're going to have great audio across the board. Okay. Very interesting already, though. SoFi seeing quite the bump up. Any amount of QE or in a form of a type of QE is going to get markets pretty excited. SoFi up 2.3%. Is it priced in? Well, maybe not fully. The stock continues to pump higher, 27.50. We go back to the SPY. Take a look here. The SPY is up 0.3%, seeing a nice little boost, 685 now. But it does look like there is going to be a form of reverse management purchases starting December 12th, beginning with $40 billion per month in T-bills. Very, very interesting. From the summary of economic projections, it actually shows 6 officials out of 19 did not favor a cut. Okay. So the total 19 individuals, 6 said, please, no cut. Stephen Mirren, who said that he wasn't going to do 50 basis points to jeopardize the 25 basis points of cuts. I guess he knew that it was going to be a slam anyway, so he dissented for a 50 basis point cut. Quite interesting. All right, the market likes this, but we are not done. In just a little bit, we are going to see Jerome Powell come up and sort of do a little conference as well as Q&A on the expectations for the rest of 2026, which right now is sort of a spread between thoughts of 2 basis point cuts, which is what people are pricing in, versus what the Federal Reserve has actually said, which they expect 1 cut in 2026 and no cuts in 2027. Who does know these days? It's all about the Q&A. We want some Nick Temeros in there. We need some Q&A. SoFi will be $28 by 2028. Yeah. Good luck with that one. Everyone says this, you know, everyone says that the stocks are, you know, going to stay where they are and people can't predict that they're going to go higher. Chime even. I had to fight all of you guys to potentially like this name. There's a couple people in chat that were riding with me since the beginning, but come on now. 5.5% up on the day. They are taking positively to this news as well. Where is the Qs as well? Where are they at? Triple Qs are flat on the day, still seeing a nice bump on the 25 basis point cut. I never changed my mind. I always thought that we were going to get 25 basis points. I'm happy we did. Let's hear some more commentary, though, from CNBC, because I want to hear just a little bit more. And then, obviously, we're going to hear the conference. The CNBC, let me know in the comments, did they also do the conference on the live stream? Because one, I want to watch it, but I also want to see the reaction to the stocks. And if they have that built in already, I might just watch it through their platform, or if there's a YouTube video, rather than watching it directly on the Fed. Who knows?
And it was for purchases to begin again in April. So this is quite a bit earlier.
Inject this liquidity reserves, and that's a lot of what's going to maintain, I think, some of the bullish sentiment in the markets, which is what we're seeing reflected, is actually the net dovish component, even though they raised the bar for the next rate cut. So I think it's a bit ironic.
Well, also, Jim, back to you, because a lot of people are listening or watching at home going, all right, this is great. What do I do? Well, to Kelly's point, the NASDAQ ticked up, the XLK on pace for its 13th straight day of gains. That would, I think, tie for an all-time record, or at least going back the 8 years. Why did stocks move up if prospects for more rate cuts went down?
Yeah. So effectively, one of the big concerns that was in the marketplace was that the Fed would have very inflationary policy, that they would be dovish and that they would push these long end rates higher because whoever the next Fed chair is, could potentially cut rates a lot. What the Fed is telling us right now is that they're not willing to do that. So what that's doing is it's stabilizing the back end of the yield curve. It's allowing the equity markets now to say, oh, we don't maybe have to worry so much about this inflation impetus that might come out of a Fed that's too dovish. So again, ironic. And that is actually something that's very supportive for the equity markets if rates stay relatively stable and well contained.
Yeah. And Steve, you want to jump in here?
Yeah, I wanted to back up what Jim was saying about the dovishness of the balance sheet decision. We asked in our Fed survey, which we released yesterday, about the balance sheet expectations, and it was for purchases to begin again in April. So this is quite a bit earlier, and for purchases to average just about 28 or 30 billion. So this is more than that. So on that front, for sure, I would also point out that when I'm looking at the immediate reaction of the market, it's a little bit more dovish in terms of that next rate cut. We had it more fully priced in for June before the statement came out, and now it's about a 57, 58% probability for April. That's going to bounce around. And all of that said, this entire discussion, I would point out, may go out the window next week when we get October and November employment numbers, as well as some inflation numbers, and we'll figure out if the Fed made the right call here and whether or not the forecast is worth either the paper that was used to print it or the digital space it's taking up on the web.
That's an excellent point. As always, Steve Leisman. Francis, the Fed has two mandates. I mean, people forget about that. We always talk about inflation because of what happened during COVID and prices spiked and inflation was 9%, blah, blah, blah. But they also have the jobs mandate, maximize employment. How do we read the jobs part of the picture vis-a-vis what the Fed may or may not do?
Yeah, I've been thinking a lot about this because I keep wondering to myself, how can you be cutting interest rates when inflation is this high and per our forecast going to be heading higher? In fact, it's really hard to see when that next cut is going to come through. I have to agree with David here. When is the window to do that? Because by February, we see that inflation side moving higher. And yet, Brian, this is not interest rate driven inflation. This is tariff level inflation. This is inflation that is coming from a labor market that is shrinking, immigration, retirements that are coming through. And part of me wonders if this Federal Reserve is saying our interest rate policy is far less relevant to the inflation side of the picture than it is to the job side.
Okay, let me follow up with that. Do we ignore, I hate to say this, do we ignore inflation? If exogenous factors, tariffs, whatever, are contributing, labor costs during COVID, whatever, if they're contributing to inflation and there's nothing the Fed can realistically do about it, should they cut rates anymore at all?
Well,
why not raise rates?
Here's the rub here. The problem is if they don't actually contain inflation, it can spiral out of control. So you start with tariff level inflation, you start with some wage pressures that sort of create a floor underneath. If you don't respond to it properly, if you're too easy, then that can start to spiral. But there's another elephant in the room here, which is that we have phenomenal amounts of fiscal spending. And how funny it is to me that we spend so much time attributing monetary policy to inflation, and we forget that expansionary fiscal policy is also very inflationary. So the forces on inflation are wide ranging and shouldn't just go to the Federal Reserve policy. So it's not a surprise to me that their bias is towards the labor side of the mandate.
Well, I think the other part that we're not talking about is just how high the equity market has been. I mean, this is the end of 3 booming years for the equity market. And I personally don't think the Fed ought to be cutting aggressively or at all right now, but it's not because of what they're going to do to inflation. Or
so you would have dissented. You would have not have cut rates.
I would have dissented, and I would have voted the way I did with what I said, because the problem is that they have caused asset bubbles over the years by keeping rates at an unrealistically low level. And I think the danger is they're just going to cause another asset bubble. And when these bubbles burst, they cause tremendous damage. So there's nothing wrong with a federal funds rate at 3.75% to 4%. I think that's okay. The economy should be able to do.
The president would disagree because people want mortgage rates to go down to 5%.
Well, the mortgage rates, long-term mortgage rates are determined by the 10-year, not short-term rates. And if you scare people about inflation, or indeed if you cause a booming stock market, that actually will probably help keep those long rates higher. So I don't think anyway, why do we have a housing problem? It's not because mortgage rates are too high now. It's because the mortgage rates were way too low for a decade, and that caused prices to spiral out of to a level that people
And
can't
who kept
afford.
them low? Who kept them
Well,
low?
the Federal Reserve.
There you go.
No, exactly.
Thank you.
But that's exactly my point. The Federal Reserve should aim for a relatively neutral level of interest rates, and honestly, that's where we are right now.
I'm going to paraphrase Animal House. You screwed up. You trusted us. David Kelly, Francis Donald, Jim Karen, Steve.
Why are we getting Animal House references here? Oh, okay. Yeah, let's see here. Advisor Hassett dissents in favor of a 50 basis point cut. Yeah, I mean, I am curious. I don't know if I'm 100% anti what he said about housing being in an environment of too low rates for too long. I mean, I'm sure that is partially true, but yeah, it's an interesting statement for sure. Okay, let's look at, someone brought up Netflix while we're waiting. Netflix, look at the price of this stock. We're almost looking year to date. This is sort of year to date here, but this was Liberation Day, Trump tariffs, the market scare, April. And coming out of that, we went from $82 up to $134. People are back. People are spending. Netflix has good content, maybe. But now, dropping so much. I wonder if, we go from 134, this is even today a $400 billion company. So 134 down to $93. Huge haircut on the share price, essentially like we're nearing 40% here or something like this, right? What's the exact rate? Oh, sorry, 30%. Yeah, why was I saying 40? But we're nearing essentially a 30% cut on the idea. Let's say they do not get this Warner Brothers deal. They have to pay out potentially $5 billion something, but I guess if Warner Brothers is the one that ends up declining the deal, then it would be in favor of the Paramount deal, then they would have to pay $2 billion. I don't know, man. There might be some version where you can buy Netflix and feel very happy about that decision, but the PE ratio is still like 39 times. I wonder what's the forward PE of Netflix. I've never been interested in Netflix. I've always just found them too expensive, but yet, expensive names can stay expensive forever, literally. So just because I find it expensive doesn't mean that that means that that's true. Let's look at forward valuation in next 12 months, 30 times. Okay, so from September 2025, there are 39 times. Next 12 months, 30.4 times. That's decent. That's fine. Yeah. Netflix is a staple. I mean, things can be a staple. It doesn't mean that I want them in my portfolio. There's a lot of staples that are not in my portfolio. When is the decision? The decision is long gone. We are getting a 25 basis point cut. SoFi isn't expensive? No, I don't think so. It's not about looking at just the PE. It's also about the growth rate. Who do you think's moving faster, Netflix or SoFi? Who has a bigger TAM? Netflix or SoFi? I would definitely say SoFi. And sorry, I shouldn't even just say TAM. It's not, but more serviceable addressable market, or serviceable obtainable market. That as well. Like Netflix, I don't think has as many levers for growth as SoFi does, and SoFi is also growing at like more than twice the rate that Netflix is growing at, with improving margins. So. Yeah, I do think Netflix here is more expensive than SoFi. Would you invest in Duolingo? I think that I think that the name is going to be fine, and I think people are way overselling the name. But personally, I also have to think about, like, what are the areas that I want to be invested in? And I don't know if Duolingo falls into that area. 5 minutes until Jerome Powell is live. Where you think SoFi will be in 3 years? As a share price or what? How the heck does SoFi have a larger TAM than Netflix? Because Netflix offers a subscription service to, users for content streaming, and SoFi is in financial services. Financial services is like literally one of the largest, I think that's just a misunderstanding of what total addressable market means. But yeah, financial services is like literally one of the largest TAMs in the entire world. There's not many things bigger than it. I do not follow Red Cat, no. Total addressable, not adjustable market, addressable. Okay, let's get ready, steady for Jerome Powell here in the next couple minutes. Do we want to hear anything more on CNBC? Anything like that? So essentially, just to recap before we go into the actual meeting. The Fed cut by 25 basis points. This was their third rate cut of 2025. If you put that up against, something like what SoFi has been expecting for rate cuts and why this is so important for this name and why I continue to look at this as a catalyst. Whenever they drum out their expectations for 2025, they assumed, 1 to 2 basis points of cuts. Okay. Now, these were end of 2025 cuts, but it does lead them into a very, very significant 2026. So lowered rates on SoFi can potentially hurt net interest income, but then what it actually does is allow them to sell a lot of loans. Their existing loan book at higher coupon rates, and this is not just for SoFi, this is across all financial services. If you have a large loan book that was written whenever rates were much higher, you're making a lot more money on those loans than you could write for new loans today. So the old loans sell for a ton of money. That's a big benefit to SoFi, being one of the largest personal loan lending and selling businesses in the world. The Fed will consider to extend the Fed will extend and timing of additional adjustments. They will also begin purchasing U.S. Treasury bills on December 12th. They're going to buy $40 billion of U.S. Treasury bills in the next 30 days. There were 2 dissents not in favor of a cut, 1 dissent in favor of 2 cuts. And the Fed is also signaling that there might not be another cut for a while. However, Fed swaps are pricing in 2 rate cuts for 2026, but they are actually signaling that they're going to see 1 rate cut in 2026 and 1 rate cut in 2027. We will see. Yeah, what color tie? What color tie? Wait, no, sorry, no. Where is come on. Press release. Where's the thing? Where's the press release? Not the press release. Where's the come on, speeches? Oh, come on. Where did this go? I just had it up. Help. 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 Where is it? Projections. FOMC. Okay, wait, hold on. Just watch it through CNBC if it's live. Okay, well, it's not live. Well, it is live, but Jerome Powell's not there. So I can just put this screen up right now really quick, but he's not there. You can't hear it? Hold on.
Goals of maximum employment and stable prices
Jeez,
for the benefit of the
I thought
American
you guys could
people.
hear it.
Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today, the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 0.75 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement or repo operations are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it's partly that consumer spending is held up. It's been resilient, and it to another degree, it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here? And have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment in the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of a big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing, but that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the two official dissents against a cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our two goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is? And you know, it's very unusual to have persistent tension between the two parts of the mandate, and when you do, this is what you see. And I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views. And you know, we come together and we reach you know, a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, you know, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple of times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted. And that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions. And you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3 is not a big data set, but you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years. And indeed, the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation. And as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation. But we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would point to a couple of things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000. So that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic, heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall, that was the judgment that we made, and that's the action we took.
Just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest-on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20-25 billion per month. So that's a small part that's going on. It's also happening in the context of a temporary few month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew. Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we don't think that we help matters by trying to engage as a public discussion of that. I'll give you a mulligan though.
No, thanks. I don't know if that means I get three questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our two goals. And so that's just unique in my time at the Fed. And I think going back a long ways, we haven't had that in our framework. Our framework, as you know, says that when that's the case, that we try to, take a balanced approach to the two things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you you've got to, and I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say. And that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward. Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, there's the announcement of a tariff, and then they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is, but call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this, and after that, again, if there are no new tariffs that are being announced, that will take 9 months to get fully in. 9 months is also an estimate. Then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very that's one part of it is inflation compensation break evens, and they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal. And our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive. So nominal wages are higher than inflation for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria.
Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market, because the labor market unemployment was very low. If you remember, when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability, and the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey, and there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month. So 40,000 jobs could be negative 20. And, that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be, but For example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance. And since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much. So it's a little bit curious. Longer term, though, the question is, what are we going to see here? And we don't know, but it's, it may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Enda. Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
the policy what?
On the committee?
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine.
Thank you, Chair Powell. Christine Romans, NBC News. Wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy? And what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think, the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a, price stability and a strong labor market. And what we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made it expensive for them to move. And, we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time. And so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Chris.
Thanks, Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? That's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think again, all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's I don't have time to think about the bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Mark, for the last question.
Chairman Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave. Sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
What a gent. All right. Yeah, the market loved that. I thought that was very, he makes me proud to be an American. I'm not even American. But very, very dovish, essentially just saying that, why am I not focused here? If there is a problem, they're willing to cut. And some of the stuff at the beginning, I don't really care for, like the stuff saying, hey, are you guys sure that you're not going to change your mind on a rate cut decision? Yeah, of course they're willing to change their mind if they see new data. Like, I never understand those questions. Like, each and every meeting is not predetermined, right? It's like he said the meeting before. It's not a foregone conclusion that we see a December rate cut, and then the whole market ended up selling off, being like, oh my God, he said it's not predetermined. We've known that forever. But the need for a rate cut this quarter, at least in this month, at least in my opinion, was very needed, right? There's no worry about inflation if it's not for the labor market. And he did definitely say a lot of the actual concerns on inflation, meaning that if they were to ease monetary policy, making inflation a little bit worse, could actually be attributable to tariffs, which might mean that it's almost a one-time charge. We see a big boost this year, and then obviously you don't keep seeing an increase on those tariffs. It's only the increase of the goods costs, right? So if you bump something up by 10%, that's not next year, if that 10% is still there, it's not another 10% next year. It has to be what's the rate of change next year on that inflation. But if tariffs stay flat, then that wouldn't actually be attributable to inflation long term. Should have paid attention when you were talking about Chime. Chime is acting the way that I thought SoFi would have acted. And what I think it is less about the meeting and more about either an activist investor, some sort of new super investor that's coming in, or even share buybacks. But yeah, they're definitely seeing the love today, 26.30. And here we were at 26.59, which I actually think is $10 above, officially, my average cost. But we're back down just ever so slightly, seeing some red candles here. But yeah, if you look back not long ago, this literal candle here where it looks like we bought the bottom, this is exactly where we bought, 16.50 or so, which was in this wick. I mean, that is freaking nice. That is a dip buy if you've ever seen one. I'm going to keep, you're just going to have to deal with it. I'm still doing my victory lap. All right. Let me have it. Okay. So in terms of the Fed watch rate now for the chance of a rate cut for next month, January 28th, we're at a 24% chance of a rate cut, which has actually been climbing. At the beginning of the meeting, I think we're at 18%. Now we're at 24.4%. So, yeah, pretty interesting. By the end of 2026, we have obviously a pretty wide spread, but 32% chance of 2 rate cuts, 23.6% chance of 3 rate cuts, 10% chance of 4 rate cuts. So it's very wide right now. But 92.9% chance of ease, 7% chance of no rate cut for 2026. What does Chime do? It's CHIME, not YME. The ticker is Y, but the actual company is IME. They are a sort of low income. I don't want to really put it that way because you can use it in any bracket, but it's who they target for banking. So not offering credit cards, not really offering personal loans, but offering the tools of a bank that would help a low-end consumer. So, no overdraft fees, a spot me service, like giving a little tiny small dollar loans, secured credit cards, credit building and monitoring services, these sort of things. But they're growing a lot of users. If you go to the Apple App Store, you'll see them at the top of the list a lot of the time. And the customers that go there stay there. It's some people's bank. Exactly. Would love to see a Chime and SoFi merger. These types of mergers won't happen. I don't think so. No, I think that whenever SoFi wants to walk down to that lower end, I think they'll have a really easy time doing that. And you have to remember, though, the customer acquisition can remain high for those users, but the profitability of those low-end users is not nearly as high. So SoFi is not wanting to turn on those, sort of campaigns for lower-end users. They will eventually. But how do I sort of put this? The SoFi Smart Card, which I need to do a video about because there's a lot more that I wanted to talk about than what we just talked about in this live stream, and I really got to go. But that will definitely target a more lower end consumer than what we've seen previously. Okay. Yeah, I thought SoFi would move on this too, but it's not about like even if it doesn't go up immediately today, that's perfectly fine. Like it doesn't really matter. People can play this however they want. SoFi's up 2%. You know, it's a matter of what does this rate cut do to their financials? A rate cut to boost up labor market participation means lower defaults on their loans. Okay, more people continue to make money, more money goes towards their loans. This means more institutional buying for their loans. This means a bigger loan platform business. This could mean, maybe people are looking to refinance credit cards. If there's a lot of rate talk, that brings that back to top of mind. SoFi might have more personal loans to do there. I'm not sure. It also cuts, that's another thing too, rate cuts. They cut deposit rates usually much more than they cut their interest on personal loans, which actually widens the spread of their cost of funding versus their actual funding. So financials will do really well. Anyways, guys, I really have to go. Thank you all so much for watching. Expect a SoFi video. Bye for now.